Have I missed anything, guys? I've given some good examples. I know there were some other questions that you guys had chalked up, but
well, I don't think our questions are nearly as important as your questions. So what questions do you have for these guys who've been doing this for 6 years? What are some of the just like off the cuff? Because I realize you're just now getting access to this information, and so a lot of it is kind of like drinking through a fire hydrant. But what are some other questions that you have that you would want to ask them?
We just don't pay. Well, Russ, you can elaborate more on that, but there is a way that you can
skip the premium.
Skip the premium.
The premium is different than the interest you owe yourself, if that makes sense.
Right.
That's set up two completely separate deals.
Right.
So just to answer your question a little bit differently than they did, I said a second ago, a loan is a prepayment of the death benefit, right? So if you don't pay the interest on the loan, you're reducing the death benefit by that amount. But you always have the ability to catch back up at any point in the future that you want to. It's your money. It's just like any time have you ever taken money out of your retained earnings account and said, I owe myself back that money? Hopefully you did, because you want to get it back in there for the next thing that comes, but the same thing is true with the insurance policy. Anytime you borrow money from the insurance company, you're not required to pay it back. It will be paid back in full at your death no matter what. The insurance company has the ultimate collateral. It's even better than that loan that Russ has on the employee. It's guaranteed to pay, regardless. There's no market downturn that will stop it. These are 200-year-old companies.
In fact, just to elaborate, I think why we're passionate about how this applies in the real estate world is because we're so seasonal and because we have these ups and downs that we really can't always know are coming. And so when you have the full freedom in how you repay a loan, it's very liberating, as they've said. There's actually a couple ways that we would always say, if you're already paying somebody else something and you take your policy and you pay that off, continue to pay yourself what you would have been paying somebody else, because that's just putting a value on your capital that's equivalent to what you would have owed somebody else, right? But you always have the freedom to say, stall for a few months until maybe that closing comes through or whatever is coming down the pike. The other part is that there's some of my clients that actually don't commit to a monthly repayment of those loans, but they know that when they get that big sale or that big quarter that's coming, they'll just shove a bunch of money back into the policy and they'll more than repay more quickly than they would have some traditional loan. Like, for instance, let's say you're only required to make a minimum monthly payment of, $500 a month to something, and it was a $20,000 loan of some sort. Well, now if you get a big $10,000 extra surplus one month, how likely are you to put that $10,000 to repay that $20,000 loan? Okay, you may be very likely. Well, that's great, but you're also a big fan of access and liquidity. Right, so you may just say, well, I'll just keep rocking on with that $300 or $500 payment, and I'll hold on to that $10,000 in case I need it, because I don't know when the next closing is going to happen, right? In this case, if you owe that policy back, $20,000, and you have $10,000 surplus sitting around, you're going to shove it back into the policy because you know you can get it right back out.
You don't have to pay appraisal fees, origination fees. However, if you're loaning them for other mortgages, charge them. I do. I mean, I charged, I basically treated my loan to employees just like a bank would treat it. I had an origination fee.
You're a shark.
Well, I mean, there is, in that case, there is some risk in it, so I need to make sure.
I'm kidding.
No, but I mean, if you look at just, for example, mortgages, I mean, was it 30-year mortgage, first 5-6 years? I mean, the vast majority of what you're paying is interest, and the average person lives in their house 7 years. Is that correct?
Yeah.
So, you know, if you think, if you have a 30-year mortgage on your house, the first 7 years that you're there, pretty much everything you're paying is interest. I pay it to myself rather than, I mean, I have my policy, actually, my personal house is paid for through my policy. So I write myself, I have a separate checking account called the Russell G. Doyle investment account. So every month I write myself, or a direct deposit from my normal checking account to there, and then then essentially upload it to repay the loan on the
With the insurance.
insurance company. It's a couple extra steps, but it doesn't hurt as bad paying myself versus a bank.